It was a double delight for the economy. The September inflation number came in below market consensus. It's come in at 5%. Economists were expecting anything from 5.3 to 5.5%. And the second positive, of course, was the August industrial growth number coming in at 10.3. It's a little better than expectation. Expectations were running at about 9.5. I mean, I don't want to play too much on the IIP number because it's coming on a very, very poor base, but nevertheless better than expected. To analyze both numbers, I have with me Upasna Bhardwaj, Chief Economist at Kotak Mahindra Bank, and Abhishek Upadhyay, Senior Economist at ICICI Securities Primary Dealer. Abhishek, Upasna, thank you very much for joining. Abhishek, to start with you, the Reserve Bank's guess is very, very good. Their nowcast seems to be excellent. Going by the average they told us on the policy day, inflation should have come at 5 and it has come. Now, do you think all of you will have to revise your full year CPI lower towards the RBI forecast?
Well, Latha, we were at 5.30 versus RBI's 5%, but looking at the reasons for the surprise, one is volatile veggies, of course, which have declined more than what we anticipated. And second is, while core inflation is lower, it is lower partly because of a puzzling sequential drop in the housing index, which is likely to reverse next month if you go by past patterns. That said, I don't want to detract from the broadly favorable internals, particularly core inflation, where what we are seeing is even outside housing, core services, ex-housing inflation is now something like 3.6%. And this aspect of inflation contradicts what you are seeing in the West, where global central banks are struggling to really bring down services inflation. And also our own previous episodes of lower core inflation, such as in the pre-pandemic period, where we had, in FY20, we had 4% core inflation, but most of it was because of lower goods inflation rather than services inflation. That tends to be stickier. In terms of outlook, our own assumption was RBI's forecasts were fine and we were close to it. In fact, if what we are seeing in the high-frequency data on the food inflation side, in case of cereals, in case of pulses, where sequential gains were otherwise very strong in the latest data that we got. If the high-frequency data is any sign, these gains are tapering out and could imply inflation in the back half of the year is closer to 5% rather than 5.5%, which RBI has penciled in. Still early days, but risks are looking like they're towards downside to RBI numbers rather than upside.
Oh, have you brought down officially your forecast? Where were you and where are you now?
So second half, we think inflation could be closer to 5% now. Earlier, we were more like 5.2, 5.3%.
Okay. Upasna, you also have had to bring down your forecasts?
Yes, Latha, I would broadly agree with what Abhishek has to say. 5.3 was our estimate, and now going by what are the internals, the second half of the year looks to be averaging around 5% versus, let's say, RBI's number of 5.4. We too were at around 5.3%. So full year average of 5.4% is where we were. Now we have officially revised it down to 5.2%.
Okay, that's good to hear. But Upasna, your note pointed out that you would still worry about pulses and cereals. Can that throw a negative surprise?
No, absolutely. I think, specifically for pulses and oilseeds and all the, sowing has not been up to the mark. And also the reservoir levels they still are below par. So going ahead, there are huge amount of risks on the food side. Food prices will remain a point of worry. We've accounted to an extent some kind of upside, but there are always shocks which tend to surprise on either direction, and we'll have to be ready for that as well. So there are clear upside risks on the food inflation, which we'll have to be cautious about.
Okay. Abhishek, you don't think that pulses are that big a danger?
So pulses inflation is already at 13%. Of course, if you go by, past episodes of stress, in case of pulses, we have seen inflation as high as 46, 47% YOY. But I do believe government is likely to have learned from those episodes. Also, more broadly, what we are seeing is that global food prices have remained reasonably well behaved. Crude prices, despite recent geopolitical developments is still around levels that look fine. We have not had a drought-like situation that should really catapult prices
Of
higher.
course.
Yes, sowing is lower, but we don't have, we likely will not have a very big shortfall in output. So in that context, I would think that upside risk of food inflation may not be as significant as we have seen in past episodes, such as after the
Fair.
GFC.
Fair enough. Upasna, what are the chances that the Reserve Bank is happy with this number and may not pursue with its OMO policy with that much rigor? Or do you still expect that they are going to keep the interbank call rate at 6.75 rather than 6.5, and they will continue to follow a tight policy?
Latha, whatever the respite is at the moment with the 5% inflation, I don't think anything really changes from RBI's point of view. The global situation still remains adverse. Oil prices is one risk, but besides that, we look at the US Treasury yields. Yes, because of the safe haven, because of geopolitical risks, we have seen a downward shift in the yield curve in the US, but that doesn't look to be sustainable at the moment. And if that is not the case, I don't see RBI really letting go of their guards at the moment. So the hawkishness which was sounded in the RBI policy and the needs that they have shown for a tighter liquidity will continue to be the key point of focus at this point in time. Having said that, I don't really see a very aggressive need for OMO sales. OMO sales is a tool which RBI will use as and when required to ensure that liquidity remains broadly neutral to a little tighter phase so that the overnight rates probably are closer to the MSF rates. But more so on the OMO sales side, if I was to go by the liquidity numbers, then I think the need for OMO sales could still arise more in November, wherein we are looking at liquidity being more sustainably in surplus compared to October.
Yeah, there are a goodish number of redemptions. Abhishek, your thoughts on OMO, and more importantly, what kind of a range, therefore, will you give the yields, both overnight as well as the 10-year?
Well, so we were expecting some sort of liquidity tightening measure from RBI, but were somewhat surprised with the choice of OMO sales as an instrument, because the issue with using this tool is that markets get confused whether the purpose is to withdraw liquidity or is it to really push yields higher and tighten financial conditions. We have seen in the past that because India tends to run high fiscal deficits and bond markets are anyway saddled with a huge bond supply, the scope to carry out large OMO sales is somewhat limited to begin with. That said, I do believe that to the extent OMO sales are partly meant to finish the task left incomplete by the ICRR, something like 50,000 crores of OMO sales should be anticipated. We've been surprised. We're a little surprised. Announcement has not come yet, but we do anticipate something to come soon. If liquidity tightening is the objective, then these sales will need to be front-loaded, because anyways, come peak festive season and end of a year, currency leakage will bring down core liquidity surplus. But this is an aspect, the pace, the size, and the details of OMO sale operations, which is a hanging sword on the market and will continue to impact sentiment. In that context, and with global yields also heading higher, my assumption will be the downside to yields is quite limited in the near term. So we're looking at a range of, say, something like 7 quarters, 750, 755 for the 10-year over the next couple of months.
755. You agree, Upasna? It goes above 7.5.
We are at 750. So, it's a matter of how global situation really pans out, and hence how aggressive RBI will need to be in order to tackle the situation. So we are also in the 725 to 750 range, Latha.
I'm given to understand that Reserve Bank has been selling dollars as well today. So there could be many reasons why liquidity will tighten. Point is taken. Very quickly on growth, I didn't want to harp too much on it, but Abhishek, 10.3 is still better than the average we got. Do you think we have something good coming on growth?
Well, so as you mentioned, partly optics, but even sequentially, the performance of sectors such as capital goods, infrastructure goods continues to be very strong, and that reflects a very strong public capex. I mean, the first half of the year that we've seen. So center capex in the first 5 months is up 48%, state capex first 4 months was up 62%. So that is what is reflected in the these segments. For us, the elephant in the room continues to be exports, which are a big part of manufacturing. And on that front, what we have seen on the global growth side is that while US growth has been resilient, growth outside of US has been quite weak more recently. So export continues to be a worry, and for that reason, we think full year growth will still be lower than RBI projection of 6.5%.
You are at what, 6?
We are at 6%.
Upasna, yourself on growth?
Latha, for us, there are two factors or two segments that we are closely watching out. One, like Abhishek said, exports. We'll have to continue to monitor that very closely. But the second is also the consumption growth. While the IIP number this time for a change, consumer durables was relatively far better than what we've been seeing in the previous readings. But overall, we remain skeptical on how really the consumer demand is going to pan out, especially with rundown on financial savings that we've seen and continued labor market mixed data that we're seeing. So I think somewhere we do remain watchful on that, where we believe that consumer demand may be fizzling off going ahead, and second half maybe seeing that pan out. So we are looking at 6.2% for the full year, with clearly the best seen already in the first quarter, and moderation will be seen in the subsequent quarters.
I know, actually, both your fears are well taken. Export, a bit of a question mark, especially with the new war raging now. And, domestic consumption, especially rural consumption. Thank you very much, Upasna and Abhishek, for joining in this conversation. I just want to put 3 numbers on the table. It's very, very early days, but I don't like the trend that this data of the 3 IT companies which announced numbers indicated. TCS has reduced its headcount by 6,333. Infosys has reduced its headcount by 7,250. And HCL has reduced its headcount by 2,250. So all told, some 17,000 fewer jobs. And what Milind Lukkad told us at TCS is that there will be an even further or a similar reduction in headcount in the coming quarter as well. Now, if the IT companies are not going to hire, then it is going to be a consumption problem if this trend continues. I know I'm extrapolating from a small number, but that trend isn't looking good. And the software companies also bring us export earnings. So even there, we could get a hit. Those two definitely remain red flags for the India growth story. On that note, we wrap up on Bazaar. Chartbusters up next.